A very good morning to you. The top stories from Sky News live in the City of London. Borrowers are urged to act fast as hundreds of mortgage deals are taken off the market. Members of the crisis-hit CBI begin voting on its future. Flying off the shelves, Harry Potter publisher Bloomsbury posts record sales, and I'll be speaking to its chief executive. Plus, the rise of Nvidia, how the AI chipmaker joined the tech elite with a valuation of $1 trillion. A very good morning to you. Thanks so much for joining us here on Ian King Live with me, Wilfred Frost, filling in for Ian this week. An hour, of course, of business and economic news from the heart of the City of London. Now, a group of tech experts warned yesterday that artificial intelligence could wipe out the human race. But AI is big business, of course. And yesterday, the tech giant Nvidia, which supplies artificial intelligence hardware and software, joined the elite club of the likes of Apple, Amazon, Alphabet and Microsoft when it was, albeit briefly, valued at more than $1 trillion. Nvidia makes chips that are key to AI technologies, such as the ChatGPT generative AI chatbot. And on Monday, it launched a new range of products for AI, including a supercomputer platform. Well, joining me to discuss this is Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Sophie, thanks so much for joining me. I mean, a remarkable feat, of course, from AI. There's 4 or 5 companies still over $1 trillion. It's the 8th to cross it. Of course, some of them have fallen back since. It puts UK innovation a bit to shame that they've had that scale of success. But while we all know that they, linked to AI, they're linked to computer games and making chips for all of that. Just break down for those of us that aren't experts on broadly what Nvidia does.
Hi, good morning. Great to be back. So you're absolutely right. Nvidia is very well known for its gaming chips. So essentially, it produces and is well known for producing the very clever, very high memory chips that go in graphic-heavy video games. And that's where Nvidia has really kind of made waves from when it started. The difference is that very high memory capacity is exactly what AI needs. So when you're training AI algorithms, you need this particular chip that Nvidia makes, and that's where this huge market excitement has come from. And just to put that into a little bit of perspective, you mentioned ChatGPT there. Well, training ChatGPT used 10,000 of Nvidia's chips. So that's the kind of scale that we're looking at here.
And again, in terms of this latest pivot, I mean, it was a huge company. It was doing incredible things in the gaming space that made it really not just the lead player, but the only player when it came to manufacturers wanting to power their gaming consoles and the gaming part of PCs. When did this pivot come towards powering AI too, and how critical is it to its valuation? Is it 50-50 AI and gaming, if we're being crude, or what's the balance?
Yeah, certainly. So really, Nvidia's been kind of growing its AI area of the business for quite a few years now. It's been kind of rumbling away in the background, but it's only been in recent weeks that we have seen this absolute explosion in the focus onto AI. And there's a couple of reasons for that. In its latest earnings, so its results that it released to the market, a few weeks ago, it mentioned huge increases in revenue that massively surpassed analyst expectations because of the AI surge. We've only seen the AI trend really go quite viral and kind of into the more public sphere more recently. So that's what's happened. And then also, in recent days, it's released the announcement saying that it's got this new, bigger and better AI chip. And that's where the market last week got very, very excited. And in terms of how important is this for valuation? Well, actually, the level of excitement that we're seeing for Nvidia is purely coming from AI at the moment. This very, I describe it as a frothy valuation. That's very much coming from AI excitement. And I think the fundamentals of the core business, so that gaming that you were talking about there, I think that's being left behind a little bit at the moment, which does increase the risks of ups and downs.
Well, let's touch on that, on the share price performance, because, like all of the big tech stocks, it initially peaked in 2021, pulled back significantly through no fault of its own, really, as the entire NASDAQ did. And then this year, it has ramped aggressively. Just talk us through the share price performance over the last few months, and then link it to where its valuation is now in terms of, as you say, whether there's a risk that this is getting into sort of bubble-like territory.
Yes, absolutely. So the performance of Nvidia has been really very impressive. As you say, there's been broader excitement around tech, and it's very much been swept up in that. One of the reasons that we're seeing really quite substantial increases with Nvidia is it's not just focused on tech per se. It's an important supplier to the tech space. Now, that is a higher margin, arguably more attractive place to be than, say, somebody that is producing tech hardware. So its operating margins are very attractive compared to some others in the space. So that's a big leader there. But as we all know, price is what you pay and value is what you get, that old saying. And the valuation now is very toppy. Now, the excitement to a large degree, I think it is warranted. There is a lot to be excited about where Nvidia is concerned. But the degree of this valuation growth, so what the market is prepared to pay per $1 of future earnings is very high. So there's certainly a lot to live up to. I'm not saying it can't do it, but the bar has been set very, very high.
Yeah, amazing rebound. More than halved from late 2021 to early 2023, and then comfortably more than doubled, up about 160% from trough to peak over the course just of this year, the last few months. So just expand on that quickly as we round things off, Sophie, in terms of whether there are lessons to draw for the broader US market at the moment, which is, put the rest of the world to shame, as is so often the case, and including just over the last month, the FTSE's down about 4 or 5%. The US market, the Nasdaq in particular, is higher. To what extent is it focused just on just a couple of stocks like Nvidia?
Yep. So the huge focus on tech in the US is certainly a contributing factor. There's no getting away from it. Whereas the UK, we know the UK market, particularly for the FTSE 100, is very much weighted towards very beaten up sectors. That includes things like financial, so your big banks and your insurance companies, which are exactly the kind of stocks that struggle to find their jumping off point, their lifting off point when economic conditions are wobbly. To say the least. So there's that kind of dynamic going on as well. And then, of course, there is the wider conversation about the wider competitiveness of London compared to the likes of New York in terms of how comfortable the LSE is for high growth companies and keeping hold of homegrown talent as well. We have a great tech minds in this country, but a lot of them are finding themselves going overseas. So there is certainly a broader conversation to be had about how we can better keep hold of that talent.
Sophie, thanks so much for joining us.
Thank you.
Right, time for some other business headlines now. WH Smith's has forecast a higher full-year profit as it bet on strong travel demand during the summer. The retailer said it's seen robust trading across its global travel business. The company reported that its total group revenue for the 13-week period ending the 27th of May was up 23% year over year. The UK's first post-Brexit trade deals have come into force. Under the new agreement, tariffs on all UK goods exports to Australia and New Zealand will be removed, with red tape slashed for digital trade and work visas. The first shipment of British goods will include signed Beano comics. Longer lorries will be allowed on roads in the UK from today. The maximum length has been extended by over 2 metres, meaning they'll have a larger tail swing and bigger blind spots. It's aimed at moving more goods in fewer trips, but safety campaigners say it's a risk to pedestrians and cyclists. Well, 10% of all residential and buy-to-let mortgage deals have been taken off the market over the last week. House buyers have been urged to act quickly before mortgage deals are replaced with higher rates or removed from the market entirely. According to Moneyfacts, since core inflation figures came out higher than expected last week, lenders have pulled at least 390 residential deals. Rachel Springle from Moneyfacts joins me now. Rachel, excuse me. Thanks so much for joining me. Let's just touch quickly, more broadly, around the last week, on the sort of level of the best rates that have been available over the course of this calendar year, and whether or not those best rates are the ones that have disappeared of late.
Indeed, yes. So our research has actually revealed that the volatility in the market has returned surrounding the future interest rate expectations. What's actually happened within the residential and buy-to-let market is that lenders are perhaps temporarily withdrawing some of their mortgage ranges, and we're looking at fixed primarily, as in fixed rate mortgages. Obviously, with those, they are ideal for borrowers who want that bit of peace of mind with locking in for, say, 2 or 5 years. But in terms of rates, as you rightly say, we are looking at volatility across the rates as a whole. So mortgage interest rates on the fixed rates are rising. And if, again, we look back at perhaps, say, a year or so ago, we were looking at around an average of 3% on your fixed mortgage. You're actually now looking over 5%, and it's nearing 6%. We haven't seen averages of 6% since the volatility surrounding the fiscal announcement. So we're keeping a very close eye on what's going on the market. And again, a lot of these lenders may well be temporarily withdrawing their ranges, but we are urging borrowers to obviously have a look at what deal you have right now, see with your broker if you can refinance, because a lot of lenders are pulling fixed rate deals.
So let's just focus on these fixed rate deals because it's easier to compare, obviously, and it's a good indicator of roughly where the market's at. As you said, they spiked temporarily around the mini budget last autumn. They did settle back down for quite a decent period of time to some availability of 3.99%, for example. As you said, ticking up of late. But is it fair to say for a different reason than was the case back in September? Not necessarily a good reason, inflation is sticking around, but it's not that momentary spike because of a sort of disastrous economic policy.
Exactly that. We're not seeing the kind of volumes that we saw back then. We are seeing more of a temporary, perhaps knee-jerk reaction to the future interest rate expectations. So the way that lenders obviously need to appreciate their own business model is to price accordingly. So when they have low fixed rates and they're tying their borrowers in for 2 or 5 years, they have to maintain that fixed rate. So what lenders are doing at the moment, they're reassessing their propositions, and they're trying obviously not to be too low, not too high. So it has resulted in a few fixed rate mortgages actually being pulled off the market while they reassess their propositions.
I mean, we've been debating a lot whether it's petrol prices, food prices, the extent to which the companies are price gouging and making excessive profit. What's the view on the banks here? Because it's interesting that the Bank of England base rate, and then again, if you look out further down the yield curve, the 10-year yield, for example, we're talking of rates in and around 4%. So if they're offering these fixed mortgages at 5 or even 6%, is that an excessive margin that they're trying to arbitrage before that? What is the long-term norm for a bank on those sorts of margins?
Yeah, I mean, that's a really interesting question. But again, every lender will have their own business model. And what we've actually seen the last few weeks is a lot of the deals to be pulled were from building societies. Now, mutuals can work a lot quicker than banks in terms of pulling and launching new ranges. But the way that banks work is they look primarily across pricing. And that's something that we are noticing at the moment. So what I would say is have a look at the big banks and the biggest lenders in terms of what they're repricing their mortgages at. So they could be having to make a lot of hikes in the next few weeks and days, months, to kind of compensate for these future expectations of rate rises. Indeed, with base rate expected to go to 5.5%, they need to have a rethink about what they're pricing right now.
And then just finally, I mean, lots of debates, when it comes to the economy more broadly, but specifically house prices as well. We saw them decline for 4 or 5 months in a row, then just fractionally tick up more recently. Raised the question from some, is the worst of the house price decline behind us? But I guess, are we getting a glimpse over this last week that A, it takes a long time for interest rate rises to filter through to the market, and B, that there's no prospect of interest rates falling anytime soon?
Absolutely. So a lot of these interest rate changes are not an overnight sensation. They do take a few weeks, if not months, to filter through. Indeed, if you're on a revert rate, you might not immediately see a change, but over the next 3 to 6 months, you may well. Now, what we would say in terms of the mortgage pricing and housing supply is that demand is high and supply is short. And if you have that within your housing sector, regardless, you're going to have the key issues of affordability and a cost of living crisis on top of that, with affordability for buying a house, is a not very great concoction. So the fact that a lot of the fixed rate mortgages are being pulled at the moment and repriced is just going to cause more issues for borrowers looking to afford a new deal or indeed get on the housing ladder.
Rachel Springham, thanks so much for joining us. Well, we talked a lot on this programme about the lure of listing in the United States versus here in London. And ARM, the Cambridge-based microchip designer, was, of course, the latest high-profile company to snub London and list on the New York Stock Exchange instead. But can European companies have the best of both worlds? OTC is a US-based trading platform that acts as a global gateway to US public markets for international issuers. Joining me now from New York is Jason Paltrowitz, the Executive Vice President of Corporate Services from OTC Markets Group. Jason, very good morning to you. Thanks for getting up early for us in New York. So just break down what exactly you're doing that's suggesting things are different, because clearly for a long time, companies big and small can have dual listings in multiple places. And I think what we've been debating of late with ARM as a high-profile example is really where the primary listing goes, not just the sole listing.
Right. And so what we've done here at OTC Markets is provide companies from around the world kind of that best of both worlds. We believe that companies should be national champions in their home markets. We provide the largest stock market in the US for international companies that are seeking that best of both worlds. They want access to US investment, whether that's the retail investor, the high net worth investor, the third, fourth tier institutional, or even the largest institutional investors. But they don't want to do it with that added cost and complexity of having to be a Sarbanes-Oxley compliant SEC registered issuer. The SEC recognized long ago that the disclosure regimes in London and Switzerland and Germany and the rest of the world were actually pretty good. And so gave companies the ability to have a secondary market in the US using a foreign private issuer exemption that basically said so long as they were current in their home market and making that information available publicly through our markets, these companies could have a secondary market with a stock ticker that's quoted in dollars, where the stock trades in US dollars during US market hours, while still being primarily listed on their home market. And we think this provides companies really, rather than the London or New York, it can be a London and New York. You can have access to all of the same investors. You can work out the same issues that we're hearing, whether it's valuation or access to investment capital. And you can do that again without the added kind of cost and complexity of having to be a US reporting company.
So clearly one of perhaps the biggest attraction for companies based abroad to the US, based here, for wanting access to the US market is a premium valuation multiple and earning a higher share price per unit of earnings or per unit of revenue. Does that get offset a little bit by this process? Because will the secondary listing that you'd be talking about also then trade at a slight discount to what perhaps it would have been if it was a primary listing?
I don't think so, because you're getting access to US investors that are valuing those companies based on US views and multiples. So for instance, today we had an LSE company join us in the lithium space, right? They're an LSE company, but they realize that the valuations that investors in the US are giving to things like lithium or other clean tech metals helps them kind of bridge that gap. And so by adding that US investor interest, you do see that gap kind of narrow. And companies are able to solve for that. Again, it's a trade-off because you're doing it without having to be a Sarbanes-Oxley reporting company, which for most companies is really onerous, incredibly risky, and incredibly costly.
No, I guess I was asking. It might be a premium to what their sole London listing was, but would it be a discount to had they done a sole New York listing? But we're getting in the weeds a little bit there. I wanted to move on to touch on some of the reforms that you've seen, particularly in the UK proposed, whether it's from the FCA or from the government with the so-called Edinburgh reforms. Do you think they are getting at the right issues that would solve the issue that currently exists for British companies?
I think it comes with significant risk. You know, London has always been the gold standard for disclosure and transparency. And when you look at, the exemption that we use, it really looks at London and says, your disclosure standard is excellent. And so we're going to allow you to passport that in order to be traded here in the US. To start fiddling with shareholder protections, I think is a risky proposition. And I don't know if that's really going to get you anywhere. I don't know that if you looked at the US and said, oh, that's the panacea, and it's so much easier to list in the US and you don't have all these regulations, I'm not sure that's the right argument to make. I think you have to really be careful when you start looking at taking away kind of what the core value proposition of London is, which is really strong investor protection. Again, what I would call the gold standard. And I think it's important to remember that. And that's part of why the London market is so good. If you look at who your core investors are, whether that's pension funds, insurance companies, they need those types of protections in order to make good investment decisions. And I would be cautious of watering them down too much.
I guess my final question is just in terms of the outlook. Clearly, the big factor behind why US markets have outperformed Europe has been the genuine fundamental performance of the underlying economies and companies, and that has a sort of self-fulfilling aspect to it over time. When you are marketing a British-based company via a new dual listing to the US, to what extent does it really change the decision-making of the investor? Do they not still look at it as, oh, great, we can buy the dollar listing, but it's still a UK-based tech company, and that's not as attractive as the US tech industry, which, we just discussed Nvidia, for example, just has better prospects?
Well, I think one needs to remember that for a lot of US investors, they don't have access to UK companies. And so if nothing more than just getting the visibility and putting themselves on the same level as their US peers, that becomes incredibly important. The US has one of the largest pools of self-directed investment in the world, which is what these companies are trying to access. And for many of those self-direct investors that are looking at whether it's US tech, biotech, fintech, mining, resource, they don't have access to go directly into London, Germany, Switzerland to be able to buy those securities. So being able to open that up to US investors actually gives them opportunities they didn't have before, and allows these companies to kind of show themselves off and, again, get the best of both worlds. They can stay national champions while accessing those investors that otherwise wouldn't have been able to buy into them. And I think that becomes incredibly helpful, both as it brings liquidity back into London, which is an important issue as US investors are now buying those securities. But again, it increases the valuation of the company and gives it access to that broader investment pool. Again, all of this without the kind of added cost and complexity and risk associated with becoming a full SEC reporting Sarbanes-Oxley compliant company.
Jason, thanks so much for joining us. Really interesting.
Thank you.
Right, so to come here on Ian King Live, we'll take a look at how global markets are faring this morning and also look ahead to a key vote for the CBI.
Tell me how you survive a crisis.
You prepare. Not necessarily for the specific, because some crises come out of a blue sky, but you make yourself as resilient as possible. And that's true if you're an individual or an organization or government itself. And you get into real trouble when you haven't made sensible precautions. I think of a crisis as being poised between, on the one hand, emergencies that we've practiced, prepared for, there are emergency services, and on the other hand, disaster. And what makes the difference, what tips it over, is preparation. Think about some of the things which might happen. Probably they won't, but if they did, it would be very serious. The most obvious is your apartment or your house, if it catches fire, take out insurance. Do you have a spare set of keys? Or would you discover that you're locked out, your best apparel to appear on Sky News is inside, the taxi's outside, time is ticking by? Don't get yourself into that sort of crisis situation. And those are trivial examples, but it's the little things, attention to detail. And I use the word anticipation because what it means is you conjure up a real picture in your mind, a feeling of what it would be like if it happened. They come in two forms. There's the sudden impact crisis that you can't really foresee when it will happen. And you just have to make do with the best you can if you're prepared. But the really dangerous ones are the slow burn crises. Year on year, the situation worsens, but nobody quite likes to tackle it, or it's thought to be too expensive, or governments just simply prefer to ignore it.
Welcome back. Let's get a look in on what markets have been doing overnight, particularly in Asia, where we saw some significant selling. Australia and Japan both down more than 1%. Hong Kong down 2%. And worth noting now that Hong Kong is in bear market territory, down 20% from its peak. And for the month of May, Hong Kong down 9% or nearly 10% with today's decline. In comparison, by the way, Korea in the month of May up 3% because of its links to the supply chain of AI. Europe today is down about 0.5%. It was down more at the open, in fact. In fact, Spain's now even gaining, and we're down more like 1/3% for most of Europe. France, for example, down 0.4%, had been down 1% or so at the open. So slightly improving sentiment through the morning for European trade. The FTSE, something similar as well. It is down, but down less than it was at the open, down just 0.2% at the moment. In terms of sectors, utilities, telcos are the best performer. Autos, consumer goods are the worst performers. By the way, for the month of May, the FTSE is looking at a decline of about 4%. Its exposure to China a factor in why you're seeing declines for the month of May. Quite serious declines as well, 4% for a single month. Right, let's have a look now at Forex. You can see there the pound is down about 0.5%, 124 against the dollar. The euro against the dollar down a bit more than that. Some softer than expected, better than expected, you could say, inflation data out of France, continuing a recent trend of continental European inflation, just coming in a little bit lighter than expected, and that's weighing on the euro, as it, of course, also impacts yields in Europe, declining there. And finally, let's have a look at oil prices. Down again today, 0.5% for Brent, and again, just to cap the month of May, once it's in the books at the end of the day, down about 8 or 9%. It's been a poor month for commodities in general. And let's discuss all of this. Richard Hunter, the head of markets at Interactive Investor, joins me. Very good to see you, Richard. Thanks for joining us. Let's touch first on this performance, both today and over the last month or so in Asian markets, particularly the China-related markets. Clearly, that's happening because the hopes of this post-COVID reopening economic bounce are diminishing. Has the pullback gone too far? If we talk about Hong Kong stocks down 20% from their recent peak?
Yeah, it's a tricky one at the moment because what we had seen in terms of pricing was that it was very much expected there'd be a very strong rebound after China decided to abandon its zero tolerance COVID-19 policy. Unfortunately, what subsequently happened after something of a bounce is that it seems to have stalled somewhat. Now, if you look at the projected GDP growth, which is in itself a slightly lower figure than market participants had been hoping, that's even so, that's projected to come in at about 5%. But the latest fly in the ointment was overnight. Some Chinese manufacturing data which suggested contractionary territory, and it now becomes apparent that the Chinese authorities may have to intervene again in order to give the rebound something of a kickstart. That's in stark contrast in terms of Asian markets to Japan, of course, where the Nikkei has recently been hitting record highs, notwithstanding some of the downward movement you've just mentioned overnight, partly on the back of a weaker yen, which helps its exports, but also because it's actually been able, ironically, to introduce some inflation, which is something that it hasn't been able to do for several decades.
I wanted to touch on the inflation data we've seen over the last week or so, including this morning from France. The difference between continental Europe and the UK, and I guess paired with the UK, you could put the US too, in terms of softer inflation data out of continental Europe and a bit stronger here. Clearly, that has implications for interest rates, which can affect valuations on the stock market. But it's also happening because of a slightly weaker economic outlook. So what stage are we in now? I mean, does that mean the UK is now less attractive, the FTSE 100, over the next 6 months relative to continental Europe, or the other way around?
Well, I think you make a valid point. Obviously, the ECB, the European Central Bank, has also been quite aggressive in raising its own interest rates, but by the same token, perhaps the outlook is a little cleaner. The worry, of course, is that raising interest rates in order to choke demand is something of a blunt tool, and we have concerns on both sides of the pond that if either the Federal Reserve or indeed the Bank of England should overshoot on interest rates, that could well push the country into recession Obviously, in the UK, we've avoided recession over the last couple of months by the skin of our teeth. And at the moment, the economic data coming through is relatively resilient. So that's suggesting that there are possibly more interest rate rises to come from the Bank of England. And we're not quite done on the rate hiking cycle yet until inflation is firmly under control.
Richard Hunter, thanks so much for joining us. I'm afraid we'll have to leave it there today, but much appreciated. Well, still to come here on Ian King Live, record sales for Bloomsbury as readers turn to books in challenging economic times. I'll be speaking to their chief executive. Welcome back. As the cost of living crisis continues to bite, one area doing well is publishing, as the British public continue to bury their heads in books. This morning, the Harry Potter publisher Bloomsbury posted record sales for last year. In its full year results, the publisher said sales were up 15% to £264 million for the year to the end of February. Profits up 16%, £31 million. Well, I'm delighted to say, joining me now, Nigel Newton, the Chief Executive of Bloomsbury Publishing. A very good morning to you, Nigel. Great to see you. As we mentioned there a bit in the intro, I mean, 15% up for sales, 16% up for profits, despite the cost of living crisis, or perhaps you could argue sort of because of it.
Well, we've been very lucky with two terrible things in the world helping us. First of all, in the lockdowns, people turned back to books. They became so desperately sick of watching streaming series that never ended that they turned to these funny things, first printed in 1452 by Gutenberg, that have a beginning, a middle, and an end, so you know where you stand with the book. So that created this 43% growth we've seen since the start of the pandemic over a couple of years, which has been extraordinary, and it continues. But the second thing, as you just said, is the cost of living crisis. And if a paperback book costs $6.99, $8.99, it's pretty cheap compared to other forms of diversion, including monthly subscriptions to streaming services and other activities. So yes, we and other members of our industry are continuing to see a boom through the wonderful bookshops that we supply worldwide.
Your growth numbers, though, I think it's fair to say, have been ahead of the broad market, if you kind of classify yourselves in that space. Why do you think you've been able to exceed that typical growth?
Well, I think due to a combination of strategy and luck. So the strategy is that we're unusual in our industry in combining academic publishing with general publishing. So we publish 2,300 books a year, and many of them are academic. And so they're aimed at a different market. They're aimed particularly at university libraries. And so they have their high points of the year in October, back to university, and the financial year end for universities of June. So they have their institutional funding, which is of a completely different order to the consumer demand on high streets and main streets and online bookshops, where the big moments of the year are the Christmas gift buying season and the summer paperback reading boom season, or ebook download to go on holiday. So I think why Bloomsbury has worked has been that we are a portfolio of portfolios, and in a world in which you can't really predict success, we can only predict what is good, and the rest is in the lap of the publishing gods. But we've managed, like Napoleon's generals, to pick people as our commissioning editors who are good at picking books and have plenty of luck and are passionate publishers of books they believe in, such as Louise Kennedy's Trespasses, which recently became a bestseller. This is a debut novelist who's shortlisted for the Women's Prize, set like Kenneth Branagh's film Belfast in the height of the Troubles in the 70s in Belfast, and a love affair between a young school teacher and an older barrister who defends IRA members.
And Nigel, I know you weren't you were being facetious. You weren't outright criticising the streaming world and the TV world at the top of the interview, but that you just prefer books, which I totally understand. But there's also obviously benefits of this huge amount of money pouring into TV and film over the last decade when you own rights. So do you still get a piece of this new HBO series that's coming on the Harry Potter books? Are there other titles like that where you could see a kicker to your bottom line by not by doing nothing, but by having been in the right place with these rights?
Yes, of course, and you're right. I'm a great fan of streamed television myself, but I was explaining a social phenomenon. We certainly do benefit. So when the HBO Max series starts in a few years' time, once it's progressed, there will be multiple episodes of each of the 7 books in the Harry Potter series, and thus might go on for a decade. Who knows? Do we have a financial piece of that? No, not at all. Film rights are always reserved exclusively to the author, but the impact of films on book sales, of successful films and streaming series, is enormous. And so that is where the real upside to Bloomsbury shareholders exists. There's another one coming that is very noteworthy, which is that we were fortunate to be approached and asked by the great independent publisher Head of Zeus, founded by Anthony Cheetham and run by his son Nick. And in their backlist was a book called a trilogy called The Three-Body Problem by the Chinese science fiction novelist Xi Jinlu, which foresees a future invasion of the Earth by extraterrestrial life. But people who like physics like this book very, very much because it's so accurate in describing hypothetical futures. And this has been bought by Netflix. It's being produced by D.B. Weiss and David Benioff, who you remember produced Game of Thrones. And it's the biggest, as I understand it, investment in Netflix history. And a trailer is coming out soon. It's been completed filming, and the series will stream within the year, stimulating the almost million copy sales that Head of Zeus, now part of Bloomsbury, have made of the three books in their first decade of publication. So that's another example. And a third and final one is an article appeared recently saying that William Dalrymple's magisterial history of the East India Company called The Anarchy has been bought up by Bollywood for a brilliant streaming series of British perfidy in India that I think is currently seeking its financial backers. And The Anarchy is one of the best history books you've ever read, and this new series will bring a whole new audience to it.
Nigel, we'll have to leave it there. Thank you so much for joining us this morning. Great to see you.
Thank you.
Nigel Newton there at Bloomsbury. Now, members of the crisis-hit CBI begin voting on its future today. The business lobbying group has been rocked by allegations of inappropriate behaviour, which led to the cancellation of membership subscriptions by dozens of blue-chip members, including the likes of Aviva and the John Lewis Partnership. Joining me now is Saima Kalassi-Aldridge, Chief Campaigns Director at the CBI. Thanks so much for joining me. I guess we've seen some of the press releases relating to the plan that's being put out, and of course then the process that the members will vote on. It's being titled, there's words in the release of a renewed CBI. To just give us a couple of the key points that you think will convince people that really is renewed.
Thank you. Yeah, so what we have set out today is a comprehensive programme of renewed culture, renewed purpose, renewed values. And this is the result of one of the biggest listening exercises we've ever done with our members, with our staff, and it covers culture and what the things that we need to do to, and the action that we've taken to renew our culture. We've listened to our members on our purpose, and actually that was one of the areas where they, really recognised the need to have a strong and unified voice for business, and they want to see that continuing from us. And also actions that we've taken on our people. So the Fox Williams report set out 34 recommendations, and what we've set out today is action that we have taken. We will have, by that EGM next week, have in progress or completed all 34 of those. And that is what we've set out today. And I do hope that is the comprehensive review into purpose and culture that people need to see from us.
And this requires approval from your members. I mean, is this a make or break vote from your members? The CBI could fail to survive if it doesn't go your way? And just talk us through when we'll get the results.
So the EGM is on Tuesday next week, and voting has opened today and will close just after at the EGM. And we hope to be able to announce the results that day. In answer to your other question, I think one of the really important things to recognise is this is a 30-page document, but is a comprehensive product that shows everything that we have done. We know that we needed to act. We listened to our people. We listened to our members. And the action that we've taken today and the action that we will continue to take is setting out all of that, all the product and the result of all of that hard work. This is everything that our staff have been focusing on over the last 3 months. We are making comprehensive governance changes in terms of how we recruit and who sits on our board. We have a new chief people officer and she reports into the board. And one of the things that we found was that people and culture needed to be a strategic priority, and that is now going to be the case. So, I hope that members will be able to see that what we have done is listening and acting.
I mean, I've seen some of those measures, and you point particularly in the press release to the new People's and Culture Committee. What powers does that committee have?
So I think from a governance perspective, it's really important to make sure that a board is able to look at and take decisions on strategic priorities. And in the past, people and culture was not seen as a strategic priority. And we are changing that. We know that that needs to change. And this new board, this new subcommittee of the board will be looking at our people and our culture and our processes on an ongoing basis. So we have already taken action as outlined in the prospectus and as some of the bits I've talked through. But this isn't just a, do it once and never look at it again. This is a journey. This is a process and something that we need to make sure we keep looking at and keep acting on.
And in terms of the importance of this vote, that's one thing. And the Sky News' Mark Kleiman reported yesterday that lawyers are consulting the possibility of insolvency. The other big question is whether the funding comes back or not. What portion of your prior funding has been lost over the last 6 months, and what's your timeline? When does that need to come back by to ensure the long-term survival of CBI? Are you surviving month to month, or is there runway to last for a year?
So any responsible board would be having those conversations, and that is what that is. I think we have retained the majority of our members. We did have a few dozen members leave us over the last 3 months.
Majority in dollar terms, in pound terms as well, or just in terms of plurality of individuals?
So I think it is, making sure that what we're doing is showing that members will have the confidence in us again. And I hope that that's what they will do. In terms of how many members have left, that is dozens of members. And, some of those are larger firms, have you seen? Some of those are smaller firms. But I think one of the things that's really important for us is that we represent businesses of all sizes in every sector, in every part of the country, in every nation, in every region. And I am confident that we still do retain the majority of our members that sit in those different brackets.
And again, sorry to labour the point, going back to it, is this vote a vote for the CBI's survival? If it goes against the CBI's proposal over the next week, is that it?
So this is a vote in confidence. So the resolution that's set out in the prospectus is for members to decide whether they have confidence in the actions that we have taken. The actions that we have taken are comprehensive. I wouldn't underestimate the amount of work that we have done and the amount of work that we will continue to do, not only on our purpose and why people want to be members of the CBI in the first place, but also on our people and our culture and our governance. So that is what members are voting on next week. They're voting on that confidence in the action that we've taken and action that we will continue to take. And yes, it is a very important moment. It is very important for us to make sure that we can renew that confidence, have that renewed confidence from our members. That is incredibly important, but it is a journey.
Mm-hmm. Simon, thanks so much for joining us. Really appreciate it on this busy day and week for the CBI. Well, next up was the business review to discuss the main newspaper stories. I want to get straight into bringing in our guest rather than going through some of the stories. The business editor at the Daily Mail and Mail on Sunday, Ruth Sutherland. Ruth, but before, I know we were going to dive through some set stories that we picked out, but I thought I'd actually just get your reaction on the CBI interview, if I may, and I guess the way that the business community is looking at this next week or so, and indeed whether it is a critical one for the long-term survival of the CBI.
I think it's absolutely critical for the long-term survival of the CBI. I mean, you can't underestimate the importance of this. The CBI is the flagship British business body representing us not just here, but also abroad. So it's clearly paramount importance that they are absolutely a beacon for all the things that they say that they want business to stand for, in terms of being a safe place for women to work, and in terms of women being able to pursue careers without harassment or other issues of that sort. So I think it absolutely is existential. I think you've seen some of the big businesses pulling away and reconsidering their commitment to the CBI. And I think the onus is on them to prove that they really have set the right track looking ahead.
And how hard a task have they got? I mean, even if this vote goes their way and their members sort of give them that vote of confidence, at least in the short term, how tough a job have they got to successfully rebrand and relaunch their image in the eyes of both the wider public and, most importantly, the paying business community?
I think it is quite tough, isn't it? Because think of it this way, if you're a female chief executive and you're paying subscriptions to the CBI out of your shareholders' money, that's quite a thing to think about there, isn't it? And also, it's not as if the CBI is the only option. So you've got other business bodies, you've got the British Chambers of Commerce, you've got manufacturing organisations like Make UK that specialise in certain areas. So I think the issue really is, can the CBI, should the CBI survive in its current form? Perhaps is there a better way? I mean, even before all of this happened, I would have said that the CBI was looking a little bit perhaps outmoded. You know, it's been around since the 60s. It was born out of an era when most employers were big manufacturing employers, and, you know, it was the voice of the employer against or in discussion with the trade union movement in a very different world. So I think even leaving aside the current issues, you know, you still had question marks around the CBI and its role. So I think it's good in a way. You know, let's hope that good comes out of this in terms of questioning whether this really is the right way to represent British business. And let's face it, representing British business could not be more important than it is right now. You know, when you've got a cost of living crisis, you've got very high pay for certain chief executives, and you've got a lot of people still feeling that there's a trust gap between business, between employers. Look at all the industrial relations problems at the moment. So, you know, I think the fact that business, I believe, can be a force for good, I think that needs proper, really strong representation in the UK, but also in the wider world as we're looking towards Brexit prosperity.
Ruth, thanks so much for joining us today. Really appreciate it. And apologies we didn't get to those individual stories that we'd discussed ahead of time. Right, still to come here on Ian King Live, the plant-based burger company setting its sights on the US. We'll be right back.
Tell me how you survive a crisis.
You prepare. Not necessarily for the specific, because some crises come out of a blue sky, but you make yourself as resilient as possible. And that's true if you're an individual or an organisation or government itself. And you get into real trouble when you haven't made sensible precautions. I think of a crisis as being poised between, on the one hand, emergencies that we've practiced, prepared for, there are emergency services, and on the other hand, disaster. And what makes the difference, what tips it over, is preparation. Think about some of the things which might happen. Probably they won't, but if they did, it would be very serious. The most obvious is your apartment or your house, if it catches fire, take out insurance. Do you have a spare set of keys? Or would you discover that you're locked out, your best apparel to appear on Sky News is inside, the taxi's outside, time is ticking by? Don't get yourself into that sort of crisis situation. And those are trivial examples, but it's the little things, attention to detail. And I use the word anticipation because what it means is you conjure up a real picture in your mind, a feeling of what it would be like if it happened. They come in two forms. There's the sudden impact crisis that you can't really foresee when it will happen. And you just have to make do with the best you can if you're prepared. But the really dangerous ones are the slow burn crises. Year on year, the situation worsens. but nobody quite likes to tackle it, or it's thought to be too expensive, or governments just simply prefer to ignore it.
Talking about the global meat substitute market continues to grow. And one company that's expanding its global reach is Neatburger, which has just raised $18 million as it sets its sights on the US. I'm joined now by the chief executive, Zach Bishy. Zach, great to see you.
Pleasure.
So just talk us through why your burger is different from some of the options that are also out there already.
Well, I think we're focused on the experiential side of it. I think very often what you're seeing is some of these big CPG businesses go straight to market without kind of any thought for the consumer experience. Everyone's kind of having their first time, so to speak. Mm-hmm. When you come to us, we've ensured we've curated that experience. And I think it's one of our superpowers is our proximity to the consumer. We listen, we adapt, and we make sure that they have the experience and quality they want.
And how big a challenge do you see it of entering the US market? I mean, clearly there's been a lot of competition. You're no longer the first mover. You know, Beyond Meat and the likes have been there for a couple of years.
Yeah, of course, but we're doing this in a different approach. We're targeting first and foremost from the consumer side. We've got brick and mortar stores where people can really see and feel the brand and taste it firsthand.
And in terms of where we are in the cycle for people potentially switching from real meat to alternative meat, I mean, if you looked at the Beyond Meat share price, you'd say this trend peaked a couple of years ago.
Yeah, I don't like it when people say this is a fad or it's going away. Fundamentally, we're talking about a huge cultural shift in how people eat, and there's bound to be bumps along the way. I think the data doesn't lie. Year on year, there is growth in the space. The demand is not going away. We see this internally in our own metrics and sales, and I see this externally with every other data point. And I think there'll be two things that drive this. Number one is the product and the quality of the products, and number two is price point. And I think if you look, every one of those is improving. Quality, whether it's texture and flavour, we're seeing great improvements. And then the final price point, there's been so much investment that you're seeing the price come down.
Zach, thanks so much for joining us. Sorry we had to cut it short.
No problem.
Good luck with the US launch. That does it for Ian King Live. Kimberly Leonard's next.